Hi, I'm Patu from freefincal. Yesterday we talked about how frequent 2% market falls are, and we shall continue talking about stock market risk by discussing how risky a bull market is. Forget a bear market. A bull market is risky. So this is the Sensex chart uh, as shown in Google Finance, and generally it is believed that this window, somewhere between early 2004 to late 2007, is believed to be one of the best bull runs that investors have ever witnessed. And we will see lump sum annualized returns of 56%, SIP annualized returns of 46% or so, if I remember right. We will talk about that in this window. But this window is extremely risky. And the reason why uh, people talk about bull runs and bear runs is because it's hindsight. You cannot, when you see, for like you can see here. So this is what you see practically on an everyday basis, right? This is the last few days return. This is where you are now sitting. Sitting here, I have no idea whether the future is going to be a bull run or a bear run, or it's going to be a sideways market, whatever. I have no clue. When we actually move this window nicely, make it 5 years and so on, then we say, oh, last 5 years it looks like a bull run. No, it's not. How is it a bull run? You've seen these dips here, dips here, dips here, dips here. There's actually so much risk in a so-called bull run. Just because we look at it in hindsight, it looks like a smooth journey, and that's a big mistake investors do. So this is an article I wrote, I think 2016. I hope the date is right. So I had asked. The article was earlier titled as "Anatomy of a Bull Market." Sorry, and I had asked at that point, since the market was a little bit turbulent, are we now in a bear market? If a bull run can be this bad, uh, how bad would a bear market be? Of course, the hindsight reasoning that I just told you matters. So what we're going to do is to first look at the Nifty and the P between 25th April 2003 to 14th December 2007. That's the so-called bull run period that I talked about. And in this period, you can see already the big dips in the price. Of course, the PE keeps moving up. It was almost about 12 here. It dipped about, came back several times, and then it moved to 20, 25. It's very easy for people to say, oh, average PE, high PE, low PE. In real time, it is extremely difficult for an investor to track the PE and shift their equity allocation as per the PE. It's possible, but it's difficult. That's what I'm trying to say. So that's that. Now, the next chart we shall look at is the monthly gain or loss during this period. Look at the huge monthly gain on the so-called bull run. You see a monthly loss of almost minus 30% twice. You see another big dip, minus 15%, minus 15%, minus 15%, 3-4 times. That's how bad a so-called bull market is. Of course, which is again in hindsight, it's huge losses. Minus 30% loss over a month. It's essentially a market crash. So during this so-called bull run period, which we now conveniently call because of nostalgia, there has been so many crashes. So 20% is officially a crash. So that's 20%. What's one? That's two. The market has at least crashed twice within this bull run window. See, the point we should understand is, because we are now looking at it in hindsight, it looks like a bull run. But imagine a guy who just started his investment journey around this 2003 period, 2004 period. Price moved up, moved up, moved up, moved up, and then it bang, it fell down, it crashed by that. For a guy who has suffered that minus 20% monthly loss, how will he know whether the future is going to be a bull run or a bear run, or it's going to his investment is going to get 56% annualized return? Nobody knows, right? I mean, this is the problem. In real time, it is extremely difficult to gauge what is happening. It is very difficult to time the market. It's possible but difficult behaviorally. And it is also don't the problem is we are always looking at 18% over 10 years, 25% over 5 years. We are looking at over this period, over that period. We do not look at the journey. Look how dangerous this journey has been. That's very important to recognize. So next up, we shall look at so we'll have a lump sum. That's a lump sum invested right at the start of this period, and you can see how the lump sum, that's the annualized return, and the annualized return was spectacular at the start of this period, and it quickly more or less stabilized, but it still gave a nice 56%, 50, 60. It was stabilized in this range, 50 to 60, and it gave a at the end it was 56%. That's an annualized return of 56%. People see, suppose I tell you it's very easy for me to sell equity. I can say, how look at this bull run, 56% return is possible. But when you actually look at the journey, you understand how difficult it would have been for an investor to emotionally hold on to their money, watch their money plummet so much in value. End of the day, it has gone up. But you don't know whether it will go up within the time you need the money. See, for a guy, let's say the guy needs the money around this time. So the guy suffered this much loss, then he waits, then again he suffers another loss, What will he do? How much loss can a man take? He will pull out. Then people will cry, oh, these guys, they don't have any discipline. He pulled out. It's very easy to comment about other people, but it is extremely hard to stay invested during such periods of turbulence. And this is a period of turbulence, I repeat, in a so-called bull run. So that's that. And the next graph we will I think this needs a little bit of resizing. So this is an SIP made during this period, and you can see again that's the investment, total investment made, and that's the value of the SIP. You can see that the even during this bull run for about almost 3 years later, you can see SIP touched back to the investment value. The gain in the SIP was almost zero here, and then it sort of showed up, but then it fell down significantly, and so on, and so again it shot up. this SIP CAGR is 46%. Of course, that's how it will be. In hindsight, when you look at a bull run, the lump sum CAGR will always be, annualized return will always be greater than the SIP CAGR. Nobody knows this in real time. Again, the problem is people when they see such charts, they will only see what they want to see. I agree, these are all great returns, but look at the price you have to pay. You have to go through this. I'm not saying it's difficult. I'm saying you have to go through it. You can't see a 2% loss and say, oh, I'm going to change my mutual funds into safer funds. No, you have to go through. Your portfolio should go through these fluctuations up and down. Only then you have any chance of making money. Otherwise, it's not possible. You have to sit through it. But I'm trying to tell you, it's difficult to sit through it. And when you see those 25%, 30% returns, they do not convey the journey, the danger associated with it. That's what I want to say. And so, okay, finally, this is the evolution of the annualized return after every installment of the SIP, the annualized return during this period. You can see how much it rapidly fluctuates, and then it kind of settles down. So this is what will happen to all investors. What is happening is, you should don't forget about this value here. For all investors who are doing SIP or lump sum, whatever kind of investing, for the first couple of years of their investment, the annualized return, whatever value it is, good or bad, will fluctuate rapidly, and then it will kind of settle down to some value. But it could still go down after every market crash. It will still go down. If the market keeps crashing, it will keep going down further south. But it will stabilize and then gradually move up or down depending on further market. So you have to wait for your money to hit this kind of a stage. I'm now in this kind of a plateau stage now after 10 years. But still, the risk is the same. I'm not saying the risk has come down but I've gotten used to it. You have to allow yourself to get used to these market fluctuations. Stop reacting. Why are you reacting? The reason is you're looking at the news. Why are you looking at news? Just keep, if the money you need is after 20 years, go do something else. Let the money grow for some time. It's like, it's classic story. You plant carrot, I think it's a Curious George cartoon. You plant carrots. Then after every week, Curious George used to take the carrot out and see, has it grown? No. Put it back. Has it grown? No. Put it back. If you do that, how will the carrot grow? You have to let the carrot grow for some time. You can let it grow only when you need the money several years away. You can take the chance. You have to take the chance. Your money has to suffer such turbulence. Otherwise, there's no chance of making any kind of profits from equity. So even a bull market is not a joyride. You have to get used to it. Okay, so that's what I wanted to say in this video. I have another video coming up also on stock market risk, and I think that is extremely scary. That is so scary that I don't want to make it myself. So that's that bad. But let me see. I'll have to do it. So I'll catch you again later. If you have any questions on this, comments on this, please drop them below. Please share these videos with someone who are worried about the markets. They have to get used to it. They have to face this turbulence. Otherwise, there's no way you can make money. Only point is you have to manage the risk. You have to manage the extent of the turbulence. That is what you can do. You cannot say I will avoid all turbulence. That's simply not possible. So you have to be mature about this. So catch you again later. Bye bye.